The Vox Markets Podcast with Justin Waite. Nothing in this podcast is intended as investment advice, and the people in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.
Welcome to the podcast on Wednesday, the 9th of December 2020. On the podcast today, Joe Wiley, CEO of Amryt Pharma, discusses their $40 million private placement with Leading Biotech Investors and how being listed on the NASDAQ has increased interest in the company. Plus, Tim Sykes, Chief Executive Officer of Proactis Holdings, discusses the significance of signing its first contract for the provision of its accelerated payment service, bePayd. Plus, Scott Maybury, Chief Executive Officer of PCF Group, talks about their preliminary results for the year and gives his outlook for a positive 2021. And, as always, at the end of the podcast, I have two lists for you. The top 5 most followed companies on Vox Markets in the last 24 hours, and the top 5 most liked RNSs too. You can see top 10 versions of both those lists at voxmarkets.co.uk. We'll see lots for the content. In fact, there's a new video there with Paul Hill talking to Trellis Health, an EKF diagnostics company, discuss their IPO plans for 2021. Check that out. There's also articles on Vast Resources, Sigma Rock, Amryt Pharma, Alba Minerals Year in Review, and of course, our COVID-19 index. Biggest rise of the day, React Group, up 8% to 1.325, and biggest faller, N4 Pharma, down 11.11% to 8.8 pence. Check that out at voxmarkets.co.uk.
Vox Markets is an online community of investors that runs a free mobile and desktop platform that allows you to track news and updates about any UK-listed company, offering RNS push notifications, detailed charts, pricing data, and much more. Find out more at voxmarkets.co.uk/app.
And joining me on the podcast right now is Joe Wiley, CEO of Amryt Pharma, AMYT is ticker. Joe, thanks for joining me.
Good to have you on, Justin.
Yeah. Well, listen, you know, it looks like it's all going well. Last time we spoke, you were announcing record Q3 results, raising the full year 2020 guidance, and now you've just announced a $40 million private placement with Leading Biotech Investors. So it's all going well, and we'll dig into that in a bit. Before we do, Joe, as always, if someone's listening right now and has never heard of Amryt Pharma, can you just summarise what you're about, please?
Sure. So we are a global commercial biopharmaceutical company focused on rare and orphan diseases. We have 2 global commercial assets, lamipipine and metreleptin. We are dual listed on both the AIM market in London and more recently on the NASDAQ in New York. We have given guidance. Our revenue for guidance for the year is between $180 and $182 million. And we are also EBITDA profitable and cash generative. So very unusual for a biotech. We have delivered 25 million of EBITDA this year so far.
Yeah. Well, listen, you just, you're over in New York at the moment. You listed on the NASDAQ in July. So explain to people why you've done that and what has been your experience to date.
Sure. So we listed, as you say, on the NASDAQ in July. There were really, I suppose, 3 main drivers behind that. Number one, we wanted to improve the underlying liquidity in our shares. Number 2, we wanted to target a deeper pool of specialist investors in the US. Here in the US, you have a much deeper pool of capital, but also specialists in biotech who invest in growth companies like us. And then the third was to increase analyst coverage. In terms of how it's gone, we have achieved that both through the listing and indeed through today. So we already picked up 2 US analysts, Canaccord and Cantor, who cover us now in the US. And through this placement, we will be picking up a 3rd analyst through Leerink. And we have been, frankly, inundated with requests for meetings, particularly just in following our positive data in our phase 3 study in EB. That has generated a lot of excitement in what we're doing. And this fundraise today is really as a result of that.
Well, exactly. I mean, the next question was going to be, you've been covering by these, brokers, like you said there, increased coverage by the brokers, and has institutional, interest followed? And by the sound of it, it has it?
Yes, absolutely. So, as I said, we have a been frankly inundated, as I said, by requests for meetings from high-quality biotech investors across the US. So we've been spending a lot of time doing that, and we had a lot of interest in investing in Amryt. However, one of the problems that we've had is actually a lack of liquidity. I mentioned liquidity at the start. We elected not to fundraise when we listed on NASDAQ because we didn't need to. As I said, we're cash generative, but that has created a lack of liquidity. So this investment allowed through a PIPE has allowed a number of specialist biotech investors, including Aquilo, Stone Pine, Ethereum, Highbridge, to invest alongside our existing investor Amati and a bunch of others. So we're very pleased to have got that done. Yeah,
well, talking about your healthy cash balance before the fundraise, I think it was $75.4 million in September 30th. So what are you going to use the funds for then, Joe?
Yeah, so our strategy is to acquire, develop and commercialize products in rare and orphan diseases. And we've built our business, as you know, Justin, very successfully to date through executing on that strategy. We don't need the cash, as I said, because we are cash generative. However, we wanted to capitalize on the genuine institutional interest that I have already alluded to, and recruit new shareholders who are excited by our prospects and keen to join our register. And effectively, this has allowed us to pre-fund our growth with sufficient liquidity now to execute our future plans when it comes to looking at new opportunities.
Yeah. And what's your criteria then for the acquisitions?
Yeah, so we focus exclusively on rare and orphan diseases, and the model is small numbers of patients being treated by small numbers of physicians, often in small numbers of centres, means we can have a commensurately small commercial footprint and address the market opportunity, and we're proving that by doing with our existing business, as I've already alluded to. There must be a high unmet medical need. We do focus on what we call peri-launch opportunities. That means that it's a product which is just about to potentially become approved and launched, or one that's already on the market. And of course, we look for a significant commercial opportunity. So that would be our criteria, what we're looking for.
Yeah. And we sort of mentioned it, and it seems to be going well. But how is the underlying commercial business performing at the moment?
Oh, incredibly well. As we discussed before we jumped on this call, we've raised guidance twice this year since listing on NASDAQ. So initially we guided $170 million to $175 million. Mm-hmm. Given our strong performance in Q2 and then Q3, we raised guidance to between $180 and $182 million. So, the original analyst expectation was between 160 to 165. So we genuinely have had a really strong performing, growing commercial business, generating both revenues, but importantly and unusually for a biotech, we also generate cash.
Yeah. Okay, so looking forward, people hit that follow button, or your investors already. What can they look forward to in the next few months, milestones and news-wise?
Actually, quite a lot, Justin. We've got quite a lot going on. So, if I look across the different areas of our business, in our clinical, we've obviously now announced our positive phase 3 data in EB. So we are in the process of submitting that to the regulatory agencies, both FDA in the US and EMA in Europe. So we hope to have that completed by the end of March. And hope, all going well, if we get approval, then we will be ready to launch Filsavez in a very large market opportunity in the US in December and in Europe in Q1 the following year. In addition to that, we expect to have data imminently on an opportunity in another rare disease called FCS. We have a preliminary proof of concept study ongoing there, so we will be announcing that data as soon as we have that. And we're busy also with our commercial assets. So we will be expecting to announce new geographic expansion where we get approval in new territories as that occurs, and indeed distribution agreements with as we expand our geography beyond that as well. So quite a lot to going on with that. Obviously, large catalyst of potential approval in EB at the back end of next year.
Yeah, absolutely. Okay then, Joe, as always, if you get on that most followed, in fact, you're on there today, I'm looking at the top 10 most followed, you've actually made it to the top 10, but to get up that list there, if someone liking the sound of what you're doing, Joe, but are not yet following the story, give them those 3 quick reasons why they should hit that follow button and add you to their watch list, please.
Sure. So we are a commercial biotech business generating revenues, number one. Number two, we are unusual for a biotech in that we are cash generative. And number three, we have significant catalysts to further growth, both through our opportunity to launch as the first ever potential approved therapy in EB towards the back end of next year, if our product Filsavez is approved, and indeed bringing in new assets into our already built commercial infrastructure through further business development opportunities.
Excellent stuff, Joe. It's good to chat to you, and hopefully we'll catch up in the not too distant future. Thanks very much.
Likewise, Justin. Thank you.
The Vox Markets Podcast with Justin Waite.
And joining me on the podcast right now is Tim Sykes, Chief Executive Officer at Proactis Holdings. PhD is ticker there. Tim, thanks for joining me on the podcast today.
Morning, Justin.
Yeah, and a bit of a milestone there. You've got a first bePayd contract out, and we'll talk about that in a bit. But before we do all that, Tim, it's the first time on the podcast here, so if people are not familiar with Proactis, just summarise what the business is all about, if you could, for them, please.
Sure, of course, Justin. So Proactis creates and sells business spend management software for mid-market buyers to use in order to get better value for the cost of goods that they buy, get automation efficiencies through the removal of the grit in the machine, so to speak, and to create much better corporate governance, compliance through audit trails and workflows. And they use our software to get all of that value proposition.
Excellent stuff. Okay, today, a bit of a milestone for you. Announced signed your first contract for the provision of bePayd. So before we get into the detail here, explain what bePayd is then, Tim, if you could.
Yeah, we're really excited about it. So bePayd is a super service that a buyer can offer its suppliers, which allows a supplier to get an early payment against an approved invoice in return for a small discount paid for by the supplier. What's different about bePayd is that it's targeted at the very tail end of a customer's supply chain, and that's where it's a market that is generically underserved in terms of the financing opportunities open to it. So we feel it's just a fantastic service that kind of supplier can access, particularly in this particular environment.
Yeah, and so why is this contract specifically important to Proactis then?
Well, it's important because it's the first one initially. And it's obviously really important you've got to sell one first of all in order to move on to selling many, of course. So it's really important to get the first one under the wing. It's been a long time coming in our point of view, so it's great to get it off the ground and get moving.
Excellent stuff. Yeah. Proof of concept there, done. So what is the funding model, and how does this contract convert to revenue for you?
It's interesting here in that so the bePayd could be obviously if you're accelerating an invoice to a supplier, somebody has to pay that money to accelerate the invoice. And what we offer through bePayd is either the buyer can pay that money early or Proactis could pay that money early. In this particular case, the buyer is deciding to settle those invoices early from its own balance sheet, from its own funding. And the beauty of that for Proactis is that there's absolutely zero risk in terms of a receivable. So that's for the funding model in terms of how bePayd will work in this instance with Expo-Buy.
Yeah. And what does the deployment look like in this instance?
So now we've signed the contract with the buyer. What we do is work with that buyer to market the service to its supply chain. So we're working about the marketing program, the rollout program as to how we deploy the software into those buyers and into that buyer and through that into its supply chain. So it could take up to 2 to 3 months, I would guess, in order to be able to get up and running on how they want to do that.
Yeah. Like you said, first contract, very important. Proof of concept there, got a customer. But what about future contracts coming through the pipeline there, Tim?
Well, the environment's really strong for this kind of service, we believe. Obviously, there is a desire and a need for cash flow particularly into SMEs and into the tail end of supply chains. So we think we're in a great position from a macroeconomic point of view in order to propose this solution. And our pipeline agrees with that. So we have a number of opportunities to come through. We're still in early adopter phase in reality, of course, so we need to keep our feet on the ground. But there's lots of pipeline and available to us in order to take this forward for more contracts in the near future.
Excellent stuff. Okay, Tim, well, every day on the podcast, I highlight the top 5 most followed companies. To get on the list, of course, several people have to hit that follow button on your page and add you to their watch list. So if someone's listening right now likes the sound of you, but not yet following the story, just give them 3 reasons why they should hit that follow button and add Proactis to their watch list, please.
Well, we think we're in a really interesting position and timing at Proactis. So after having had a couple of very difficult years, we've reached an inflection point where we feel that performance has now changed momentum and is moving forward positively. We have lots of opportunities to grow the business in many different ways through our core offer and through bePayd. Which is super, and that will lead to significant amounts of news flow over the coming months, which should take us into a much better place.
Excellent stuff, Tim. It's good to chat to you, and hopefully we'll catch up in the not too distant future. Thank you very much.
Thanks, Justin.
The Vox Markets podcast with Justin Waite.
And joining me on the podcast right now is Scott Maybury, Chief Executive Officer of PCF Group. That's PCF ticker. Scott, thanks for joining me.
Good morning. Thank you.
Yeah, nice to get you on. I know, like I said, you've released your preliminary results for the year ended the 30th of September today, and we'll dig into that a bit and have a look at what's happening and going forward, what your hopes are. Before we do that, Scott, for people not familiar with PCF Group, could you just give us a brief summary as to what you're all about, please?
Certainly. PCF Group is the parent company of PCF Bank, which is a small specialist bank. We've been operating as a bank for just over 3 years now. We were mobilised. We're one of the new entrant banks in the marketplace, and we mobilised in 2017. Our main lending markets are the consumer motor market, SME asset finance market. We're a specialist in broadcast and media equipment, and we're also in the property bridging market.
Excellent stuff. Okay, like I said, preliminary results for the year ended the 30th of September today. Give us some of the main highlights, if you could, Scott.
Yeah, I think like most of the results you'll see coming out over the course of the banking markets reporting period, it's about supporting your staff and supporting your customers in a very difficult year, and it's about proving that you've got a resilient business model that one has is going to perform throughout this crisis, but also going to leave you in a good position at the end of the crisis to emerge as strong as going into it. And I think our results today highlight all of those things. We spent a lot of time at the beginning of the pandemic, of course, making sure customers were looked after, and that could have meant lending more money to them if they were open for business. But in a lot of cases, it was helping them with financial hardship, which, of course, everyone's familiar now with the term forbearance, and that was very prevalent in the early days. So supporting customers and also supporting staff, operationally to start with, to make sure that they could all operate. But as this crisis has gone on, I think we're all learning that there's additional challenges to the communications around staff and staff engagement and staff well-being. Financially, the highlights are we've grown. The loan book has grown in the year, which I think you'll find will be fairly unique amongst banking entrants. We've remained profitable with an underlying PBT of 3.9 million. That's half of what we made the previous year. But when you look at an impairment charge up to 7.8 million from 2.2 million last time, you can see where most of that profitability has gone. So it's been a strong performance. We've continued to lend into the marketplace. We're lending at the moment. It's just about prudence and caution until we see some certainty on the future.
Yeah. Well, I mean, you mentioned there the resilience there. You must be very pleased with that. But what steps now did you put in place, to deal with the consequences of the pandemic, Scott?
Well, initially, it's a lot of it's around making sure your business can operate as best as possible. So, there's a lot of IT connectivity and communications and customer contact required to make sure that you're operating. Within a couple of days, we had all our staff working from home, and other than one or two staff to come in and do things that you couldn't do remotely, like check for any post coming through the door. We're effectively all at home, and there was no interruption to business. We also, the other key thing initially was some staff resource reallocation. It's about being agile with your staff resource. Forbearance is a thing that arrived almost overnight in some parts of our loan book. And of course, you're not resourced up for that on day one, but we have some very experienced staff here where we're a business that operated as a finance company before we were a bank. A lot of people that have been with us in excess of 10 years, and we were able to mobilise staff right across the organisation to put the resource where it was required. So when people talk about keeping up customer service, we really did. We didn't have to put warnings up on our website about delays or interruptions to our service. We didn't have to put recorded messages on our phone lines. We really did operate business as usual. And then I guess the third main change that we had to put in place is adjust our risk appetite towards lending. So looking at our credit risk appetite and saying, yes, we think it's still appropriate to lend, but we tightened that credit risk appetite to increasingly prime credits, which I think is prudent in this market.
Yeah. And looking back at it, when the lockdown happened, there was a lot of fear and people didn't understand what was going on. And of course, sometimes the worry about the unknown is worse than the actual unknown. And looking at the sort of forbearance figures there, it seems that your borrowers have fared better than they feared they would at the start of the lockdown. Is that sort of a fair summation, Scott?
Certainly, and different parts of our portfolio in different ways. Being a diversified business across the 4 business lines that I spoke about earlier has its strengths. If you want to see a microcosm of how a business can be affected by lockdown, our broadcast and media subsidiary was almost affected overnight. TV, film, live events basically closed their doors overnight, and that had a huge effect on that business. And our customers in that sector really did need some forbearance help. So forbearance was high in that area, also high in the SME area as well for businesses, and less so in the consumer area. But we are sort of conscious that there could be a bit of a tail in the consumer area if unemployment reaches the sort of heights that's being forecast. So it affected different parts of our business differently, but you're absolutely right. People were very cautious, and they heard about forbearance, and it was well advertised, and of course the regulator put out rules around forbearance, and a lot of people took it for really just to be cautious and just to plan ahead. And what we found is after the initial 3 months, a lot of people started returning to payment because the protection they needed was really a precaution rather than a necessity. And then added to that, of course, governments had its own support schemes which have been in place. So a number of businesses have been able to draw on the CBILS and BLS bounce back loans. And that's also helped business. And of course, furloughing has helped the consumer as well. So all of those things meant, as we stand at the moment, people haven't needed quite as much help, and they've returned to payment, as you can see by our numbers.
Yeah. And you mentioned there, lots of different businesses get affected differently. Like you mentioned, Azul is one of the bigger players in the broadcasting and events leasing space, which we purchased last year. That must have been quite difficult for them. And what's it like for them now? Is it starting to turn around, getting better for them or not?
It is starting to turn around. We're starting to see, I think it's going to have a couple of different speeds, to tell you the truth. The run-of-the-mill TV miniseries type documentary type business. I don't think we'll see that really getting back to any huge levels of activity until next spring. Of course, the better weather and the longer daylight hours are absolutely key for that sort of business, for filming and TV. Also, a lot of live events happen in summer as well. But what we have seen is a recovery in what I'd call the on-demand streaming activities. So people like Disney Plus, who have taken a 10-year lease of Pinewood, Netflix, who have taken a 3-year lease of Shepperton, and also Amazon Prime. There's a huge demand for content for those parties. It's a subscriber service, as you know, so subscribers aren't going to pay for repeats, nor are advertisers going to pay for repeats. So we've seen those bigger on-demand people come back quite strongly, and a number of deals are been happening over the last month or two, and that should bode well ahead of the spring recovery more generally.
Let's be honest. Everyone's looking forward to 2021. The vaccine is being rolled out, and everyone's talking about there's light at the end of the tunnel. And what's your thoughts on 2021 for PCF then, Scott?
Well, yeah, my aim is to really make sure we emerge from this strongly. We went in strongly. We had a strong balance sheet. We knew our markets. We've been around as a finance company before we were a bank. So, I think collecting out your loan book and operating in these difficult circumstances will be new for a number of the newer players. It's not for us. So if we can emerge strongly from this, I think there will be really good opportunities for a small and ambitious bank. I think there'll be less competitors in the marketplace. I think there'll be opportunities for portfolio acquisitions, and I also think there'll be opportunities for M&A. And they could either be in the spaces we operate in at the moment, or they might offer a new diversification for us as well. All of those, I think, will be really exciting. It's really about how quickly we actually recover and have some visibility on the future. We'll then adjust our credit appetite, and we'll open our eyes to those opportunities in the marketplace. And I think from the middle of 21, let's hope, as you say, things pan out with the vaccine. From the middle of 21, I think we can start to be on the front foot and start to be more ambitious in our growth plans again.
Excellent stuff. Okay, Scott, every day in the podcast, I highlight the top 5 most followed companies on Vox Markets. And to get on that list, of course, several people have to hit that follow button on your page. So if people are liking the sound of what you're doing here, and hopefully the recovery in 2021, but they're not following the story yet, give them 3 reasons why they should hit that follow button and add you to their watch list, please.
Well, please do. I feel like I'm talking to the judges on something like The Voice, or I'd like to, I guess the reasons why you should really follow PCF Bank is we're small and ambitious. Financials haven't had a very good time of it over the last few years, so there's a historic discount in there. And, of course, small caps within financials have been even harder hit. The second thing is the resilience, the profits we've shown today, our experience in the marketplace, our experience through several credit cycles, and our ability to emerge from this downturn in a strong position, I think should give people a nice warm feeling and some comfort that we've got a proven and sustainable business model for the future. And I would also say, as a UK business, we're a good leverage bet against a UK recovery. UK shares themselves haven't seen the sort of recoveries you've seen in the US. I think the UK market has a number of things hanging over it, not just COVID, but also Brexit and our relationship with Europe. And should all of those things pan out, as we all hope, I think the UK economy is well placed to recover, and the markets accordingly, and the operators within it.
Excellent stuff, Scott. Good to chat to you, and hopefully we'll catch up in the not-too-distant future. Thanks very much.
Okay, thank you for your time.
Okay, it's time for the top 5 most followed companies on Vox Markets in the last 24 hours. They are at 5, Supply Atme Capital, down 1% to 0.455. At 4, it's Melody VR Group. They just come back to listing on the exchange after, I think, acquiring Napster. That's up 7.14% to 3.7. At 3, Angle PLC, down 2.25% to 41.25. At 2, Brand Shield Systems down 1.9%, 26 pence. And at 1, Helium 1 up 5.36% to 7.375 pence. Okay, top 5 most liked RNSs are as follows. Mind Gym at 5, Director Shareholding. Independent Oil and Gas, Technical and Portfolio Update. At 3, Octagonal Group, Update, Re-Audited Accounts and Interim Dividend. At 2, Proactis Holdings, bePayd Contract. Of course, I chatted with Tim about that. Significant first signing of that product from them. And at 1, most likely update on asset-backed debt finance and placing to raise 4.8 million before costs. Of course, that is from Vast Resources. And quickly, let's have a look at the most read. It's Vast, Melody, yes, N4 Pharma, and that's it for the top 5 most read. Check that out at voxmarkets.co.uk. Thanks for listening. Muchos appreciados.
The Vox Markets Podcast with Justin Waite. Nothing in this podcast is intended as investment advice, and the people in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.